1. Foreign asset managers boost investment in Chinese equity market. 2. German pensions €34.1 billion investment in China stocks. Fullgoal Asset Management's new mandate. 1. Foreign asset managers boost investment in Chinese equity market. Foreign investors are making a bold move into China's stock market, but this trend isn't without its controversies. A German pension fund, KZVK, recently committed $50 million to Fullgoal Asset Management, HK, to channel investments into Chinese equities listed in Hong Kong, mainland China, and the US, a move that highlights a growing global interest in the region's financial opportunities. But here's where it gets controversial. While some see this as a sign of China's rising economic power, others question whether the market's recent gains are sustainable amid geopolitical tensions and regulatory shifts. This surge in foreign capital isn't isolated. Global asset managers, from Singapore-based True Light Capital to US-focused Earnest Partners Private Capital, have been quietly ramping up their presence in China's equity landscape. Analysts attribute this to the A-share market's resilience during a period of global financial realignment. For context, think of it as investors diversifying away from traditional US-centric portfolios, seeking growth in markets that promise higher returns, or at least, that's the theory. In June, experts at Nomura Orient International Securities speculated that Chinese equities could outperform global peers by 2025, citing factors like potential policy support, improved domestic liquidity, and a weakening dollar. But this optimism isn't universal. Some critics argue that China's economic challenges, such as slowing growth and debt concerns, could undermine these predictions. Meanwhile, local analysts like Yang DeLong of First Seafront Fund note that tech sectors, from robotics to biotech, are driving momentum, with companies in these fields showing strong performance. The appeal of China's market extends beyond just numbers. Its transformation from a manufacturing hub to a tech innovator is reshaping investor perceptions. As Dong Xiaopeng of Renmin University's Chongyang Institute points out, the country's stabilizing growth policies are creating a foundation for long-term gains. Yet, this raises questions. Are foreign investors overestimating China's potential, or are they simply reacting to a shifting global landscape? The trend also reflects broader shifts in global finance. With emerging markets offering lower valuations and AI-driven breakthroughs gaining traction, China's stock market is seen as a bellwether for Asia's economic future. However, the recent decline of American exceptionalism, a term referring to the U.S.'s historical dominance in global finance, has pushed investors to rethink their portfolios. As Liao Wanjing of Fidelity International explains, diversification is no longer a luxury but a necessity, and China's yuan-denominated assets are becoming a key part of that strategy. Even the numbers tell a story. In the first half of 2025, the Shanghai Composite Index rose 2.76%, while the Shenzhen Component and Chinext indices also posted modest gains. But here's the catch. These figures don't account for the volatility that could arise from external shocks, such as trade disputes or changes in Beijing's regulatory approach. So what does this mean for the average investor? While the Chinese equity market offers tantalizing opportunities, it's a complex ecosystem that requires careful navigation. And this is the part most people miss. The interplay between policy, global trends, and local dynamics isn't something that can be simplified into a single narrative. As the world watches China's financial ascent, one thing is clear. The country's role in global markets is evolving. But will this momentum last? Or will the next chapter bring unexpected challenges? Share your thoughts below. Do you think this is a long-term shift, or just 2. German pensions €34.1 billion investment in China stocks. Fullgoal Asset Management's new mandate. Is a major European pension fund quietly betting on China's stock market recovery? It's a move that flies in the face of widespread investor caution, and it reveals a fascinating and potentially risky shift in global investment strategies. Let's dive into the details. A significant German pension fund, KZVK, Kirchliche Zusatzversicherungsgesellschaft der Verbunds der Diocesan Deutschlands, has entrusted a Chinese firm, Fullgoal Asset Management, HK, with managing a portion of its assets, specifically investing in Chinese equities. This isn't just any small allocation. KZVK, managing a staggering 34.1 billion euros, approximately 51 billion US dollars, has reportedly allocated 50 million US dollars to Fullgoal's Hong Kong arm during the second quarter of this year. The mandate is broad, encompassing stocks listed in Hong Kong, mainland China, and even the United States, all tied to Chinese companies. But here's where it gets controversial. Why would a large, traditionally cautious European pension fund be increasing its exposure to China, especially given the recent market volatility? For context, Chinese and Hong Kong stocks have experienced modest gains recently, spurred by government stimulus measures. However, these gains follow a period of significant losses triggered by regulatory crackdowns, a slowing economy, and escalating geopolitical tensions. Many long-term investors were caught off guard by the severity of the downturn, leading to a general reluctance to commit new capital to the region. Analysts at Mercer, a leading consulting firm, have observed a distinct lack of enthusiasm for Greater China among European and U.S. asset owners. We haven't seen a significant trend of European and U.S. asset owners allocating mandates to Greater China, stated Cameron Sistermans, head of multi-asset for Asia at Mercer. Their advice to clients aligns with this cautious approach: build equity portfolios without a strong, long-term bias towards any single country. This highlights the unusual nature of KZVK's decision. And this is the part most people miss. Despite this new mandate, KZVK's overall exposure to China remains relatively low. Oliver Lang, a management board member at KZVK, revealed in a recent interview that the pension fund is currently underweight China compared to the country's actual economic size and market capitalization. This suggests the 50 million US dollar allocation might be a targeted, opportunistic play rather than a wholesale shift in strategy. Fullgoal Asset Management, the firm entrusted with the mandate, is a substantial player in its own right. Based in Shanghai, it manages approximately 200 billion US dollars in assets and boasts Canada's Bank of Montreal as a shareholder. Its Hong Kong arm, which will be executing the investment strategy, manages around 30 billion Hong Kong dollars, roughly 4.9 billion US dollars. KZVK, based in Cologne, manages funds for over 240,000 pensioners, demonstrating the significant responsibility it carries. According to a 2024 survey by FinCity, Tokyo, large global institutions typically allocate a minimum of 50 million US dollars when investing in emerging markets, making KZVK's allocation consistent with industry norms in that regard. Representatives from both KZVK and Fullgoal declined to comment on the specifics of the arrangement. While KZVK is cautiously dipping its toes back into Chinese equities, capital is flowing elsewhere in Asia. A recent Morningstar report indicates a surge in ex-China equity funds, with record launches in both 2023 and 2024. These funds attracted an unprecedented 10.5 billion US dollars in net new capital last year. This trend underscores the broader investor sentiment, a desire for Asian exposure but with a reduced reliance on China. Matthew Caquino, a senior principal for equity strategies ratings at Morningstar, explained the regulatory crackdowns and governance issues, rising geopolitical tensions around the world, and economic uncertainty in China since the COVID-19 pandemic have unsettled investors, fueling the appeal of ex-China offerings. Now, let's consider this asterisk. Is KZVK's move a sign of a broader, albeit slow, shift in sentiment towards China, or a calculated bet on a short-term rebound? Do you believe the risks associated with investing in Chinese equities outweigh the potential rewards, especially given the current geopolitical climate? Share your thoughts in the comments below. We'd love to hear your perspective on this evolving investment landscape.